you all on the topic amendment related to assessment year 2021. Friends, at the outset, let me confess that I would be dealing with the amendments and provisions related to statute and not related to ITR filing. Let me accept and confess that I'm not very well versed with the procedures of filing ITRs, but nevertheless, I'll try to make an attempt whenever the questions are raised on those issues. I would just have a screen share. One second. Yeah. Normally, friends, you will see that the amendments related to assessment year 2021, when we refer to, then they are carried out in the amendments made in Finance Act 2021. And also, few of the amendments which could be in Finance Act carried out in Finance Act 2022, but those should be limited and restricted. But this year, unfortunately, if you see that the amendments definitely carried out in Finance Act 2019 and thereafter again Finance number 2 Act 2019, Taxation Amendment Act 2019, Finance Act 2020, Taxation and other laws, that is the ordinance which came and the related notifications on account of the COVID which were also announced, and few notifications and rules which normally we do have it on year, we can see that. So coming to our straight to the topic, friends, if you see the surcharge, well, there is no changes as far as the tax rates for the individual HUF or firms and companies are concerned. However, there has been major change as far as the surcharge is concerned. And that surcharge that you all are aware, they have levied, increased the higher rate of surcharge to super rich persons. That is, if the income is between 2 crore and 5 crore, it is 25%. And if it is if it is exceeding 5 crores, it is 37%. Otherwise, the surcharge has remained same as far as the companies and domestic company and firm or LLP is concerned. The two other changes as far as the tax rates are concerned is that the one other rate concern is that for the purpose of MAT, they have reduced from 18.5% to 15%. And one must be careful regarding the total income, which includes any income chargeable under Section 111A and Section 112A, that is related to our short-term capital gains and long-term capital gains. The rate of surcharge shall not exceed 15%. That is for the super rich, even if the income of a person, individual, is say 10 crores. But that 10 crore comprises 7 crores coming out of long-term or short-term capital gains. Then the surcharge of super rich, that is 37%, will not be levied on that. It will be restricted to the regular income, that is 10 minus 7, 3 crores. Therefore, he falls into the bracket of 25 crores. And on capital gains, the surcharge will be restricted to 15%. That is what I was trying to explain through this example which I have just mentioned. Now coming to, friends, during the entire today's talk, wherever I say the Finance Act, we have to understand it is connected to assessment year 2021, unless I specifically mention that it is to or for any other assessment years. From Finance Act 20, you will see that the tax rates, except for, here the rate of depreciation on motor car, other than those used in a business of running them on hire, acquired on or after 23rd August 19, but put to use before 1/4/2020, the rate of depreciation on such motor car will be 30%. Similarly, if the motor car, buses, lorries are used in the business of running them on hire, acquired on or between the same period, that is 23rd of August 19, but before 1st April 20. In that case, the rate of depreciation will be 45%. And these two amendments have been brought in by way of Income Tax 9th Amendment rules, and which has been dated 30th of September 2019. Now, friends, this amendment, we all are aware that section 56 to 10, which we normally now call it as a deemed gift. So whenever there is a transfer of money or immovable property or any other property for any inadequate consideration, then except for certain exceptions, that is if it is received from relatives, then this will be treated as a part of income in the hands of the recipient. They have extended this scope with effect from 5th of July 2019 to a resident giving a sum of money or a value of property, which is referred to into 2427A, again read with section, which again refers to section 26 to 10. If a resident is giving to a non-resident, that will be treated as a deemed income in the hands of a non-resident. A small amendment on section 1012A, wherein if there is any withdrawal made from NPS National Pension Scheme Trust, then that withdrawal amount exemption will be which has been increased from 40% to 60%. Now this earlier, which was 40%, they have extended to 60%, and that could be even earlier it was withdrawal, now it is withdrawal, or it could be on account of closure of the account. Tinkering with again the standard deduction, that is section 16(1), which we all are aware, which was 40,000, has been increased to 50,000. Okay, thank you. The next amendment, which takes us to the two new sections which has been inserted. One is 80EEE, which provides that an individual will be eligible for a deduction in respect of interest on loan taken for acquisition of an affordable residential house property up to rupees 1,50,000. But then they have levied certain conditions, and that is that the loan sanction should be from financial institution, and that should be during the financial year 1920. And the stamp duty value of the property, it should not exceed 45 lakhs. Plus, the assessee who is availing this benefit should not own any other residential house property on the date of sanction of the loan. After the loan is sanctioned, he may buy another property, that is a different thing. But on the date when the loan is sanctioned, he should own only this one property for which he has taken the interest, trying to take the interest as a deduction. Over here, I would like to make it clear that there has been little ambiguity about the stamp duty value. What if the agreement value exceeds the stamp duty value or is different from the stamp duty value? Whether the assessee will still be eligible. Just to take an example, if the agreement value is say 55 lakhs and the stamp duty value is 45 lakhs, that is the ready reckoner value of the property is 45 lakhs. In that case, whether this benefit of 80EEA will be available, the answer to that would be yes. Still he will be eligible. Same way, vice versa, if the stamp duty value is 45 lakh or less than 45 lakhs and the agreement value is much more below, that would in any case not make a difference because they are considering the stamp duty value. The next section is 80EEB, which is a provision again applicable for an individual, and the deduction is on interest for a loan taken for the purpose of purchase of an electric vehicle up to rupees 1,50,000 and which is subject to loan if it is sanctioned by a financial institution from 1/4/19 to 31/3/23. As far as then amendment to section 80IB, it is related to the housing project which has been approved by the competent authority between 1/6/16 to 31/3/19, and because there was a sunset clause of 31/3/19, they have extended that sunset clause by one more year, and therefore it is available up to, if the project is approved, the said project is approved by the competent authority up to 31/3/20, the SSC will be eligible for the deduction under this section. In between, it appears that I have missed one slide. Okay, I'm sorry. I have missed these two sections in between, that is 43B, EA, which is, we all are aware that 43B is allowed on payment basis if the payment is not made before the filing of the due date of the return of income of certain expenditures which have been claimed for that respective year. Then on the basis of payment, that is whenever those payments are made, the said deduction will be allowed. Now they have increased this to the interest payable to non-banking financial companies. Earlier, all banking financial companies were covered. Now they have extended to non-banking financial companies also. So now if the interest which has not been paid to a non-banking financial company, then as per the provisions of 43B, the same will be allowed. As far as section 54 goes, deduction of, we are all aware that this 54 is that for the beneficial of a person who has purchased a residential house, which is arising from the sale value or the capital gains, long-term capital gain from the sale of a residential house. The same was allowed against an income from capital gains and from against one residential house. So if an SSE who had a capital gains on sale of a residential house, if he was purchasing one residential house, the deduction to the extent of that one purchase of value of that one purchase or construct to the extent of that one residential house was allowed. Prior to this one residential house, the word used was a residential house. So there was an ambiguity whether the word a residential house should be restricted to one residential house or more than one residential house. Thereafter, in assessment year 1920, they have they replaced the word a residential house by one residential house. And now from assessment year 2021, if the amount of capital gain does not exceed 2 crore, the SSE can purchase or construct two residential houses. So for a capital gain less than 2 crore, the word one residential house shall be replaced by two residential house, but this benefit will be available only once in the lifetime of the SSE. Yeah, now that brings me again back to our same flow of section 87A. Section 87A, this applies only for a resident individuals, wherein if the deduction up to 2,500 was available as a rebate, subject to if the total income of the SSE does not exceed 3,50,000. This was the provision for assessment year 1819 and 1920. Prior to that, again, the higher rate of rebate was available. But from assessment year 2021, again an amendment, and which says the rebate is been increased up to rupees 12,500, and the limit of income should be not exceeding rupees 5 lakh. So in case of total income exceeds 5 lakhs, then the quantum does not exceed 5 lakhs, then the quantum of rebate will be nil. Let us say that if an income of an SSC resident individual is 5,10,000, in that case, the tax will be 15,080 rupees. That is for an additional 10,000, the SSC will be required to pay, that the individual will be required to pay 15,080 rupees. So one needs to, if possible, plan it in such a way that for a small amount of income, he does not pay much more than the income by way of a tax. Here, friends, we will have to put in some more time, that is, and very much relevant because of the new proviso that has been inserted to section 139.1. We all are aware section 139.1 has two categories of SSCs who are required to furnish return of income under the within the due date specified. Now, two categories are first category, that is a company and firm, and the B, it is other than company and firm if his total income exceeds the amount not chargeable to tax. So the second category talks about an individual or a firm or a local body, cooperative society, if his income does not exceed the maximum tax rate up to what he said. Let us take an example of an individual HUF. If it does not exceed, if it exceeds 2,50,000, then mandatorily he is required to furnish the return of income. So if we don't see any of the provisos, then only these two categories are required to furnish the return of income within the due date. But then there are provisos to this section 139.1, and up to assessment year 1920, there were 6 provisos. Out of the 6 provisos, the first 2 provisos again were almost redundant. They were applicable for a year or two so. And now they have introduced the 7th proviso, and which reads as under, and which is applicable with effect from 1st April 2020, that is assessment year 2021. And it says that subject to the first 2 categories, that is A and B, which I just discussed, the following, if the following criteria are also followed, then he is required to submit the return of income, which says A1 has deposited an amount or aggregate of the amounts exceeding 1 crore rupees in one or more current accounts maintained with a banking company or a cooperative bank. I think this is nothing much that we have to discuss about, or we have no issues on this. It is the aggregate amount of deposits that needs to be considered from all the bank accounts that the individual is maintaining during this financial year. B, has incurred expenditure on an amount or aggregate of the amounts exceeding 2 lakh rupees for himself or any other person for travel to a foreign country. Now here there are certain ambiguities. Number 1, it talks about 2 lakh rupees for himself or any other person. So if a person is an individual who has incurred an expenditure and thereafter that expenditure is reimbursed by, say, a company, or that expenditure was otherwise to be subsidized or otherwise to be sponsored by some company, in that case, whether, and I understand the total expenditure exceeds rupees 2 lakhs, then in that case, whether he is covered by this proviso. According to me, the wording used as such, yes, the expenditure he has incurred once this expenditure, in that case, he will be covered by this proviso and required to file the return of income. Let us take an example of a minor. A minor has, I would say, travel wherein the expenditure is more than 2 lakh rupees, but that expenditure is incurred by a parent. In that case, whether that minor as such is covered by this proviso, the answer to that will be no. The expenditure is incurred by his relatives, a parent, because here it talks about for himself or any other person. So any of your relatives also, if you are paying, in that case also, if it exceeds 2 lakh rupees, you are required to, you will be covered by this proviso. What do you mean by expenditure for travel to a foreign country? Will the expenditure incurred on the stay, hotel, lodging, boarding, conveyance in that foreign country, all that will be included? Is it the entire tour expenditure of the foreign country, or is it only for traveling to a foreign country that I have incurred will be considered? The intention of the legislature is very clear, that they want to cover the entire expenditure if it exceeds 2 lakh rupees. But the wording is that for travel to a foreign country. So I have incurred an expenditure to travel to that foreign country, say the airfare, or if I'm traveling by ship or any other modes. In that case, any travel expenditure, should I restrict to only the fare of that transportation, or do I have to include it? So in my view, I would consider that expenditure of the entire amount needs to be considered if you are incurring for the threshold limit of rupees 2 lakhs. One more issue would be there if I have incurred an expenditure, say 1,90,000 is towards my traveling and all, and 12,000 is towards the visa charges. Whether visa charges are part of the travel to a foreign country, to that my answer would be no. Visa charges are not part of the travel to a foreign country. You may take a visa, but you may not travel. So that may not be part of your threshold limit if you are considering. And more commonly, which will be applicable, is that you have purchased the tickets in the month of, say, January and February, whether that, and thereafter, because of this lockdown and COVID and all, the person could not travel, whether that would be considered as an expenditure. To me, it is not an expenditure thereafter, because you will be taking as a refund or a set off against your further travels, depending upon what option you have availed for by and the airline company, what they have given you as an option. Now, and if you at all are maintaining books of account, that individual is maintaining books of accounts, in that case, he would rather not debit this expenditure to the profit and loss account. He would be showing it as an advance or recoverable from that agent or that airline. So this is not an expenditure which is incurred. I understand that, yes, once you purchase the air ticket, it is an expenditure which is incurred. This brings me to another query, that if a person has purchased ticket in the month of March and he has traveled in the month of April, that is in the different financial year. In financial year 1, he has purchased the ticket wherein the expenditure is less than 2 lakh rupees, and he has traveled in the second financial year wherein also the expenditure is less than 2 lakh rupees. Whether this is to be, whether the SSC would fall in the proviso. Now, this is a peculiar situation, but it could be very commonly found, because many a times, if it's a foreign trip, people do make their travel arrangements much before in advance. And because of that, there would be 2 financial years wherein you would be incurring an expenditure. So this expenditure, do we have to consider the threshold limit of 2 lakhs? Is it for the entire 2 or is it for a financial year wise? I would understand that we will not be incorrect. I can understand that people will have a different views on this. It would not be incorrect if I would say that year-wise, financial year-wise, if you are taking an opinion that yes, in financial year 1, my expenditure has not exceeded 2 lakhs, so I have not considered myself as this proviso applicable to. So these were the certain issues which would arise for applicability of this proviso 2. Now the third one. SSC has incurred expenditure of an amount or aggregate of the amounts exceeding 1 lakh rupees towards consumption of electricity. Whether this consumption of electricity is for your business purpose or residential purpose, irrespective, if he is an individual who is carrying a business in his proprietary concern or an HUF in proprietary concern, he will have to consider the entire consumption of energy, electricity, whether for a household, office, factory, anything. If it exceeds 1 lakh rupees, then he is falling into this proviso. And the fourth one would be a very harsh one, I would understand. And that says, fulfills such other conditions as may be prescribed. Now, for these 3 conditions, friends, it was the legislature who had to amend the law. Now, the power is by the legislature has given the power to the CBDT that they can prescribe any other conditions. Say, for example, if they want, they will say that if you have incurred any expenditure by if you have used your credit card up to 1 lakh rupees, aggregating all your credit cards, then also they may cover. Another example, which is very likely, certain expenditures at clubs or hospitals, then also they can cover. So now they don't have to go to the parliament to get this approved. They can just prescribe because they have taken a blanket permission from the parliament. And well, I have already covered this, that he will be required. So if these conditions are applicable, he will also be required to furnish the return of income before the due date as may be prescribed. Certain amendments related to section 194A, TDS related to, so first is 194A. TDS on interest other than interest on security, the threshold limit, which was of 10,000 rupees, has been increased to 40,000 in case where interest is payable by a bank or a cooperative bank or a post office. But here again, friends, the overall threshold limit for a senior citizen still continues to be only 50,000. That has not been increased. And for other payers, it still is only rupees 5,000. Next, threshold limit has been increased in case of 194Is, that is for the purpose of rent. Payment for the purpose of rent is increased from 1,80,000 to 2,40,000. 194IA, a threshold limit of 50 lakhs for deducting TDS on a consideration for transfer of immovable property. There were mixed opinions and different opinions that what do you mean by consideration for transfer of immovable property? Is it the only agreement value that is to be considered? Agreement value of the immovable property, or are other payments which are connected to when you are transferring the property, which are connected to that property, are also to be considered? And payments like club membership fee or car parking fee, I'm sorry, the spelling mistake, that is CAE is a mistake. It's car parking fee, electricity or water facility, etc., etc., or any other charges of similar nature, which are incidental to transfer of the immovable property. So whether in your agreement, it is 50 lakhs only, and then you are paying some other club charges or any other charges. The charge is not in the nature of transfer fees to the society or stamp duty to the stamp office. Those charges are not considered, not to be considered. What are paid to the transferor, those are to be considered for all, aggregating those are to be considered for the purpose of that 50 lakh rupees threshold. So they have expanded, or rather I would say they have clarified that all, whatever name you may call, if you're paying it to a transferor, then the 50 lakh rupees, if it exceeds the limit, then you need to apply 194IA. We have two newly inserted provisions on the TDS under section 1 as 194M and thereafter 194N. Let us take 194M, which is applicable to an individual and HUF who are otherwise not required to get their books of accounts audited. But if they are incurring any payment, if they are making any payment toward supply of labor for carrying out any work, that is for one nature what is under section 194C, commission or brokerage 194H, or professional fees 194J, and if it exceeds rupees 50 lakhs during the financial year, are required to deduct TDS on such payments at the rate of 5%. The issue comes over here that whether a person, if he is making a payment to a same person, say 30 lakhs, which is on account of 194C, that is for carrying out any work, 10 lakhs for commission or brokerage, and or say 20 lakhs for commission or brokerage, whether the provision of this section 194M will apply, or it will be only considering a threshold limit qua 190 qua for carrying out any work, it does not exceed 50 lakhs, therefore it should not apply, or commission or brokerage because it does not independently exceed 50 lakhs, it is to be considered. The section reads like this: any person being an individual HUF into bracket other than one who is not required to deduct tax under section 194C or H or J, responsible for paying any sum to any resident for carrying out any work by, or a comma, by way of commission or brokerage or by way of professional services, then he is supposed to, and if the threshold limit exceeds 50 lakhs, he is supposed to deduct TDS. So in the example that I have given, I will repeat that example. For carrying out any work, he has paid 30 lakhs, and above that he has paid a commission and brokerage to the same person, and which exceeds, for the easy consideration, exceeds another 21 lakhs. So the aggregate of both comes to 51 lakhs. Then the provisions of 194M will be applicable. That is what my view is. The another provision which is applicable by way of, which has come by way, inserted by way of section 194N and applicable to a bank or a cooperative society or post office, and which says, though it is applicable to them, but indirectly because of taking the credit and checking the transaction, whether the SSC has carried out and considered in these books of accounts or not, we need to also check this provision of 194N, which says that if the cash payment exceeding rupees 1 crore, then he is required to deduct, the bank is required, or the post office is required to deduct TDS at the rate of 2%. And if the SSC has not filed his return of income for all 3 assessment years relevant to the previous 3 years for which the time limit of filing the return under section 139(1) has expired, in that case, then the 5%, 2% will be considered as 5% if the sum of withdrawal exceeds 1 crore, and the threshold sum also will be reduced from 1 crore to 20 lakhs. So from 20 lakhs to 1 crore, it will be 2%, and if it exceeds 1 crore, it will become 5%. The person who does not file the return of income, or if he files and the bank does not have an evidence, then the bank will deduct a higher rate of TDS. So one needs to make sure that he should submit the return of 3 years return of income to the bank in case if the withdrawals are likely to exceed 1 crore rupees. Now we have another amendment which has come by way of Taxation Laws Amendment Act 2019. I will have to give some more time over here because of it's a newly inserted section, and it's an alternative tax regime for domestic companies, applicable to domestic companies. New section, that is section 115BAA, has been inserted. Friends, we all are aware that if we relate back to maybe not beyond 5 years also, or say a little more than 5 years, then basically there were only two types of distinctions as far as the tax rates for the company were to be applied. One was a domestic company and another was a foreign company. The different two tax rates for both the companies were there. Thereafter, we saw that as far as the surcharge is concerned, definitely for foreign companies and the domestic company, the surcharges were different. But however, within the domestic company, if the turnover, if the profit of that company was up to 1 crore, then there was no requirement to pay surcharge. But if the profit of that company was in between 1 crore and 10 crores, then the surcharge was 7%. And if it exceeded 10 crores, the surcharge was 12%. Then after, another criteria was also introduced based on the turnover. We saw the first criteria was based on profit, then the second criteria again was introduced based on turnover. The was less than 400 crores, say in financial year 17-18. Then for assessment year 2021, the company is required to pay tax at the rate of 25%. And if the turnover exceeded 400 crores for financial year 17-18, then for assessment year 2021, the company will be required to pay tax at the rate of 30%, and then subject to the surcharge, what we have just discussed a minute back. Thereafter, we also have a provision under section 115BA, which is applicable only to manufacturing domestic companies, and if certain conditions are satisfied as per the provisions of 115BA, then the tax rate is again 25% only. Well, that being a new and not an amendment, I will not run through that provision of 115BA. And now from assessment year 2021, we have two new provisions, 115BAA, we very commonly call it as BA and BA. Here, friends, if you see, before I run through the provision, this provision is more friendly to the investor company or a service company or small size trading company, wherein the depreciation as per the Income Tax Act is not very high as compared as compared to the depreciation as per the Companies Act if he is adopting in his books of accounts. And plus, if it is a manufacturing company, then there are no big size plant and machinery wherein the benefit of additional depreciation would be available to that manufacturing company. Because if it's a manufacturing company, then there is a proviso under section 32 which allows you for an additional depreciation of 25%. Then that company will not be able to take the benefit of that additional 25% if he has opted for 115 BAA provisions. Now, therefore, and one more company, that is which would be covered under MAT or by way of if he is eligible for MAT credit which have been brought forward from earlier years, those type of companies also will not opt for this provision. Now, why they will not opt? Because this domestic company will not be able to take the benefit of, and there are certain conditions attached. First of all, there is, of course, there is no restriction to what the turnover 400 crores and less than or more than. However, the total income of the company shall be computed without claiming certain specified incentives such as additional depreciation under section 32(1)(2)(a), which I just discussed a minute back, deductions under section 10AA, 32AD, 33AB, 33ABA, etc., etc., and section 80C to 80U except 80J, JAA, and 80LA or 80M. Well, I will just bring to your notice that they have again amended they have made a small amendment as far as chapter 6A deductions are concerned, and wherein now, because of that amendment from assessment year 21-22, the 80C to 80U should be read as 80HH to 80Q except 80JJA. So therefore, a very common expenditure which would be 80G, that will not be allowed to be claimed as far as assessment year 2021 is concerned. From 21-22, that 80G deduction will be allowed as far as the domestic company who is opted for 115 BAA. I will come to the issues little later, because after discussing this brought forward, how difficult it would be for a company when this brought forward losses, and there would not be the company who is opted for 115 BAA, that company will not be allowed to adjust any brought forward losses which are on account of the deductions which I have just referred in the above bullet. And therefore, no set of such loss or unabsorbed depreciation referred to what I have attributable to the deduction which I have referred just above will be allowed. Now, the calculation part, otherwise it seems simple that yes, if it is a company who does not have any brought forward losses, who does not have any MAT credit, otherwise that company is not covered by MAT, it's paying on the regular tax. All right, that type of vanilla cases, I understand that there is a benefit to those domestic companies and can avail the benefit of a lower tax deduction. Because here, the company which is opted for 115 BAA, the tax rate are 22%. However, the surcharge is higher. Instead of 7%, it will be 10%. And that higher education cess is 4%, which is common. So here the tax rate would be 22% plus surcharge 10% and higher education cess of 4%. The company which has opted for this benefit, they need to exercise this option in year one. That is, say, if in year 2021, then they need to exercise this option by way of submitting form number 10 IC online. And that submission should be done before the due date of filing of the return of income. We understand now when we come to the due date of the filing of income, that has been extended. So we will take that extended due date for filing of the return of income. And the flip part of it is that once a company exercises this option, it cannot be withdrawn subsequently for the same, for any other previous years. Therefore, today, if a company is otherwise a trading company, for 2 years, it decides that yes, it's a plain vanilla type case, so I better opt for this. And thereafter, it sees that, oh, there is a good scope for manufacturing the same product, what it is trading into, and it puts up a plant and machinery. Those plant and machinery are eligible for a higher rate of reduction, that is additional 25% will be available. However, as per, and it pays tax as per not regular computed income, but it pays tax on the MAT provisions, then the company will not be allowed to take the benefit of this additional depreciation, because in year one, it has already opted for 115BAA. Unless we have some, again, amendment by way of simplification or ease of doing business in India, then it's a different thing. But as the law stands now, this benefit would not be available. So one needs to be careful and advise their clients accordingly that, look, if you're opting it today, be careful that henceforth all these benefits you will not be able to avail in this company. The issues what I wanted to bring through is, as you saw, friends, the additional depreciation of 32(1)(2)(a) and the brought forward losses will connected to that additional depreciation or brought forward losses connected to 35AD or 35A, 2AB, etc. Say scientific research expenditure incurred on that, and there is a loss, or say because of 35AD expenditure incurred on that, and because of that there is a loss. Depreciation, the SSE has claimed a regular depreciation, say of 15%. They have also incurred, claimed additional depreciation of 25%. Now, as far as the brought forward unabsorbed depreciation or brought forward losses goes, they are all one figure, an aggregate of that one figure, which includes additional depreciation, which includes regular depreciation. Same way, the loss, which could be a business loss, which could be on account of my regular business loss, I have done a regular business loss, and plus the loss which I have incurred on account of a scientific research expenditure incurred for scientific research. How do I bifurcate today for assessment year 2021 that, look, I have 10 crore rupees which is on account of unabsorbed depreciation as far as after the calculation of 32 goes. And that 10 crore rupees is an accumulated figure of past 3 or 4 years. Now, in this past 4 years, I would have claimed additional depreciation, I would have claimed depreciation on other than plant and machinery, plus depreciation on plant and machinery. Today, how do I bifurcate? All right, since I'm taking a benefit, I will request my accountant or my chartered accountant to please help, and let us do a reworking of both these two figures separately. 10 crores, let us decide what is the figure on account of regular depreciation and on account of additional depreciation. I come to the figure that, okay, 7 crores is on account of depreciation, which is regular, and 3 crores is on account of additional depreciation. And can I say that, okay, this 7 crores still I will be able to adjust? I will not be able to adjust only 3 crores. And assuming subsequently out of this 10 crores, the SSE or the domain, that company has already adjusted 4 crores. So the outstanding is only 6 crores. While calculating, do I set off this 3 crores against this 4 crores, or do I set off 7 crores? The department will definitely say that, look, you should set off 7 crores first. So you are allowed to only carry forward the balance 3 crores. Well, as an SSE, we will say, since you have not laid down any priority, so whatever is beneficial to the SSE, as the courts have laid down in various decisions, since that priority has not been laid down in the statute, the option is with the SSE to set off where the priority which he feels which is better for him. So the SSE will set off first against that 4 crore, he will set off that 3 crore. So whatever balance 6 crore is remaining is nothing but out of the regular depreciation, which he will be allowed to set off in the subsequent years. The similar analogy, but it will become more complicated when the business loss, which is set off against, in 1 year if there is a loss, second year again some portion is set off, third year again there is a loss, fourth year something is set off, and then there in the fifth year there is a start of the year, assessment year 2021, I have a figure X. How do I calculate? But the same analogy, what I just discussed, can be worked out, and because whatever is beneficial, that priority can be applied, and the balance amount, which is not related to any of these sections, can be carried forward and set off in the subsequent years. Now, this brings me to another section, 115 BBA, BAB. This is available to any domestic company which has set up. So it has to be a new domestic company which is not only set up, but which is even registered on or after 1st October 2019. Otherwise, normally we had the unit is set up. Here it talks about a domestic company and not a unit. So which is registered on or after 1st October 19 and has commenced manufacturing or production after 110, definitely if it is set up after 10/19, but before 31/3/23, and subject to certain conditions, and those conditions are like how we had earlier, ATI, ATIA, B, etc., where it should not be on the new company, should not be on account of splitting up. Now, if you see the condition says it should be a new undertaking. Whereas if you see the opening section, it talks about any domestic company registered on or after 110/19. A company, if it is registered after 19, can I draw an analogy then? That, okay, I have registered a company after 1st October 19. That company has set up one unit A before 31/3/23, second unit B, which is also before 31/3/23. The unit A is out of the splitting of my another, or say, let us understand, either splitting or using old plant and machinery. And unit B, which I have set up, is using new plant and machinery, and that is not out of splitting of any existing another group company, I understand. Whether that company can take a benefit, but I cannot really figure out that how would that company apply the tax rate of, because the tax rate of 15%, the lower tax, beneficial tax rate of 15% is applicable to the company. So the unit A in our example, say, has profit of 5 crores. Unit B has a profit of 10 crores. So total for that a newly registered domestic company, the total profit is 15 crores. Now, how do I say that, look, of this 15 crore, 5 crore, I will apply tax rate of regular. For 10 crores, I will apply tax rate of 15%. That is the beneficial. The answer to that would be no. That is not what they are looking for. Then why have they used the word new undertaking? That is still a question mark. I can understand. The new undertaking would be undertaking, in my example, undertaking A. It's a new undertaking. And that new undertaking is also not out of splitting up, and does not have an old plant and machinery, and does not manufacture any article, any item which are not otherwise restricted. Plus B unit also, all those conditions are satisfied. In that case, since both the units have started production before 31/3/23, they can get the benefit. Both the units get a benefit of this lower tax rate of 15%. This is what I understand how we can interpret the word undertaking over here. Plus certain conditions that no adjustment for brought forward losses pertaining to above mentioned sections, that is MAT provisions. If it's a new undertaking, where is the question of that? But in going ahead, also if you have but no provisions for MAT benefit etc. is available, straight away a tax rate, that is a regular tax rate of 15%. Here also the surcharge is higher, that is 10%, and the education cess of 4% will be applicable for the company which is taking the benefit of this lower tax deduction, a lower tax rate. Now that brings me to a very important provision related to the assessment year 2021. I would say one of the very important provision, and which is related to our tax audit. And I understand when Seema madam also told me that will you take up the presumptive taxation, presumptive tax also. So I would like to cover over here only that relevant issues. Friends, 44 AB, as you all are aware, has got limbs of A, B, C, D, and E. That if any of these 4 limbs you fall into, then you require to carry out the audit under section 44 AB. The limb A says, that is A, it says, the clause A, now I will use the word clause A, it says, person carrying on business and his total sales turnover etc. exceeds 1 crore rupees in the relevant previous year, then he is covered. He is covered for 44 AB and he requires to get his accounts audited. That is what was there till the amendment to Finance Act 20 was there. By way of amendment Finance Act 20, effective from assessment year 21-22, assessment year 2021, that is effective from 1/4/20, a new proviso has been inserted. And this proviso has created various issues. First, the proviso says, A, the aggregate of all amounts received, including amount received for sales, turnover, or gross receipts during the previous year in cash, does not exceed 5% of the said amount. And B, aggregate of all payments made, including amount incurred for expenditure in cash, does not exceed 5% of the said payments. In that case, if both the conditions are satisfied by the assessee, then both the conditions, I again repeat, it is receipt as well as payment does not exceed 5%, then in that case, the turnover of 1 crore is to be replaced by 5 crores. Therefore, an assessee, if he satisfies both these conditions of cash payment and receipt, then his turnover is to be considered as 5 crores. So up to 5 crores, he will not be covered by the provision of section, by the provisions of subsection A, clause A. There are certain issues as far as the receipts are concerned, and some of them for the payments also. The wording used are including amount received for sales. Now, that means there are certain other items or certain other receipts which are also to be considered for the purpose of aggregate turnover, for the purpose of only calculating 5%, not for the purpose of total turnover or total turnover of threshold of 5 crores, only for the purpose of cash receipts. Now let us take few examples. Number one, that whether interest received in cash, brokerage, sale of scrap, etc. are also to be considered as part of receipt. The answer would be clear-cut yes, that is to be considered. Second, sale of investments, sale of any asset are to be part of receipts for this subclause A. The answer to that also would be yes. Receipts from proprietor, or if it's a partnership firm, receipt from a partner in cash. Say a partner has introduced 5 lakh rupees cash. Then whether that has to be considered as a receipt for the purpose of this subclause A. Before replying to this, let us take a second example also, another example also, that withdrawals made from a bank. That is, I have withdrawn an amount from my own current account, 5 lakh rupees. Whether that 5 lakh rupees is also to be considered as a receipt for the purpose of this subclause A. So in short, first two examples are clear. We said that yes, that are to be considered. Second, third and fourth example that I just mentioned now has certain concern. So if those third and fourth are also to be considered, that does it mean that I straight away have to take the total of my cash book, that is the receipts, and apply that these are the total receipts and apply a percentage to the, these are the cash receipts and apply the percentage to the total receipts of the concern, that is the proprietary or partnership firm. In my view, the third one which I said, which is the receipt from proprietor or partner, yes. If it is a partner, definitely yes, because a partner is a different entity as far as income tax goes, different SSC, and who has now given money. So a partnership firm, if it is receiving from a partner, definitely it is from another entity. So another SSC, therefore it should be considered as a part of receipt. If it's a proprietor concern, then the proprietor can say it is my own money which I have brought in over here. So he may have a different view, and which I understand is would be a correct view. And the fourth example that I shared about money withdrawn from bank. In that case, it is your own money. It is your own money which you had it in a different form has now come up over here as a cash. So need not be considered for the, should not be considered for the purpose of my cash receipt over here, because anybody would like to reduce that numerator and not reduce the denominator, because the denominator here would be the total receipts, and here the numerator would be the receipts by way of cash. But definitely if you have included this amount in your cash receipt as a numerator, then you need to remove it, you need to include it in your denominator also. That same analogy would apply. But as I discussed, for the fourth withdrawal from the bank, that should not be included over here. Similarly, for the payments part also, same analogy can be applied. I need not repeat the same nature of transactions. Now, coming to clause B of 44 AD, where there are no issues and no amendments also. That is, If a person is carrying on a profession and if it exceeds 50 lakhs, then he has to carry out audit. Same way, C, if it is 44AE, that is for transport industry, then also he has to carry out. And now coming to E, that is 44ADA, which is again connected to B, wherein it says that if that professional receipts are less than 50 lakhs and if he's offering 8%, then you don't have to, 50%, then you don't have to carry out the audit. Coming to clause E, now the whole problem arises over here, which reads as person carrying on the business shall, if the provisions of subsection 4 of section 44 AD are applicable in his case and his income exceeds maximum amount which is not chargeable to income tax in any previous year. Now friends, here the absurdity comes over here. Let me read the proviso also before that, before I go to the absurdity. Provided that this section shall not apply to the person who declares profits and gains for the previous year in accordance with the provisions of subsection 1 of section 44 AD, and his total sales, turnover or gross receipts, as the case may be, in business does not exceed 2 crore in such previous year. So simpliciter, if I have to apply, then I would say that, look, the 1 crore limit which was there, supposing this proviso was not inserted, then the 1 crore limit which was there has to be replaced by 2 crore if 4481 provisions were to be applied. So that becomes a presumptive tax and I don't have to carry out the audit if it is below, the turnover is below 2 crore. The problem comes now that 1 crore has been replaced by 5 crore, which is higher than the 2 crore. So therefore, a person, the situation is such now, we all are aware, when this 44 AD provisions were introduced, at that time, it was introduced for the purpose that a small time SSCs may not undergo the vigors of audit, and they can be covered under of not only audit, of maintaining the books of accounts and auditing, and they will be covered by presumptive taxation. And if they are offering a net profit, that time it was 8%, thereafter certain amendments were introduced, proviso was introduced and made it 6% subject to certain conditions. So for our easy purpose understanding, I will refer it as 8%. So if a person whose turnover was below 2 crore, if he's offering 8%, then he need not be covered under 44 AB provisions because he was covered under 44 AD subsection 1. However, if I have to read with 44 AD subsection 4 with the provision which has been introduced under clause A and read with 44 AD 1, the absurdity situation is as under. 1. The SSE whose turnover is, it's a say a mid-size SSE whose turnover is less than 2 crore and he offers less than 8%, then he needs to undergo an audit. And another SSE whose turnover, of course, now again, because 44 AD provisions would not be applicable, so a person who otherwise was not getting the benefit of 44 AD, say a commission or brokerage income, or a agency business, person having an agency business, whose turnover now up to 5 crores, he will be getting a benefit indirectly because he will be covered by the new introduced proviso. So a person who was not otherwise getting a benefit, now he will be getting a benefit And a person who was otherwise getting a benefit, say if his turnover was 2 crore, but he was not able to offer a profit of 8%, and his income was not taxable, that is a maximum marginal rate, not actually maximum marginal rate, still he was not required to get his accounts audited. Now, if a person whose turnover is, say, 1.5 crore, who has not offered 8%, whose income is above maximum marginal limit, he will be required to get his accounts audited. Simultaneously, a person whose turnover is, say, 4.5 crore, his turnover, his net profit is also, say, 5%, that is below 8%. He has offered 5%. He will not be required to get his accounts audited if the two conditions of receipts and payments are satisfied. So in both the case, in first example where the turnover is 1.5 crore, he has offered 5%. He is also able to satisfy both the conditions of cash, receipts and payments. Still, he will have to get his accounts audited. And if his second case, he will not be required to get his accounts audited because he is not covered by 44 AD at all, because his turnover exceeds 2 crores and it is less than 5 crores. This is the absurdity what has been created now. I understand that originally also there is a absurdity as far as applicability of provisions of section 44AD subsection 44AD subsection 4 goes. Because subsection 4, when it was introduced after the amendment, not the original subsection 4. Original subsection 4 was very clear and which said that, look, if your income does not, if your net profit does not show the percentage which was as per the provision of subsection 1, then you need to get your accounts audited. That was the original provision which was there in Finance Act, introduced in Finance Act 16, that is from assessment year 17-18 onwards. But after this amendment, which has been introduced, which from assessment year 17-18, and which reads like this, I am talking about subsection 4. Where an eligible assessee declares profit for any previous year in accordance with the provisions of this section, and he declares profit for any of 5 assessment years relevant to the previous year succeeding such previous year, not in accordance with the provision of subsection 1, he shall not be eligible to claim the benefit of the provisions of this section for 5 assessment years subsequent to the assessment year relevant to previous year in which the profit has not been declared in accordance with the provisions of this subsection. If a literal interpretation I was supposed to take of this subsection 4, then in year 1, if I have not offered 8%, assuming my turnover is less than 2 crores, and I have not offered 8%, then in subsequent 5 years, I will be required to get my accounts audited. But in the year 1, in which I have not offered 8%, I may not get my accounts audited. I'm sure that is not the intention of this provision. But it talks about that in the subsequent to the assessment year for the next 5 years, he will not be able to take the benefit of subsection 1. So for the next 5 years, he will have to get his accounts audited. And simultaneously, it means that once you have opted out, that means once you have not fulfilled the condition of subsection 1, for the subsequent 5 years, you will not be able to take the benefit of this subsection 4. for the next 5 years. Therefore, I have taken little more time on this subsection 4 because there is a specific question also which was raised to me. So while answering this question, it will be easy for me at that time when I have to answer the question. I need not again explain the entire subsection 4 based on my answer that I have discussed now. Now, this is the absurdity what I discussed as far as the new proviso introduced to subsection 44A, B clause A is concerned. Now, the due date for furnishing the tax audit report, they have made an amendment because the section talked about the specified date, and that time the date, that time it read as means the specified date means date prior to the due date for furnishing the return of income. It means specified date means due date for furnishing the return of income, which has been now substituted as date 1 month prior to the due date for furnishing the return of income under 139(1). So earlier we all know that, friends, September was the due date for the last assessment year I'm talking about. September was the due date for both filing the tax audit report as well as for return of income. Now it says that 1 month prior to the due date for furnishing the return of income. And we all know that similar amendment has been carried out in all various sections wherever the tax audit reports are applicable, that is from section 10, 10A, 12A, 32AB, etc., etc. The reason given is that this 1 month prior is on account of that they will be giving to the submitting to the SSC pre-filled returns. So whatever I would understand the disallowance or absurdity is there in your tax audit report, that will be captured in the return of income, which will be submitted by way of a pre-filled return to the SSC, which the SSC may accept it or reject it. I don't know what would be the consequences of rejecting that pre-filled return. For example, if a tax auditor has reported some disallowance under section 14A or an amount of disallowance under section 43B, but however they have reported under the disallowance clause, but they have very clearly mentioned that the payments for that 43B, say GST payment or interest to any bank which was not paid but till the date of signing of the audit report, but still the time is available till the due date of the filing of the return of income, because now the audit report is to be uploaded in the revised due date that has to be done by 31st of October. However, 43B says that you can make the payment till the due date of October, till the due date of the filing of the return of income. That is till 31st of October. I'm sorry, November. 30th of November. So the SSC still has a chance of making the payment within that 1 month. Now, if it's a pre-filled return, and I would say that no, I reject this disallowance, then I don't know whether this would be read as a mismatch and would trigger to your scrutiny, or would it trigger to your, I would say, incomplete return or invalid return, wherein you need to again rectify on valid your return. I have no clue how would they react. But definitely they should, if at all it is not accepted, a reason should be allowed to be given by an SSC that for X reason I am not accepting this pre-filled return comment. Another small amendment that is for under section 43(5), which talks about speculative transaction. Now, clause E to the 43(5) that has been amended, which was in respect of trading in commodity derivatives carried out in a recognized recognized stock exchange. Earlier they had used the word recognized association. Now they have replaced it by recognized stock exchange. The next one is section 72AA, which is or to amalgamation to the banking companies. I will not refer this because most of the SSCs would not be participants. It would not be applicable to them. Section 119A, Taxpayers Charter. Friends, earlier, till if you recollect, we had a Citizens Charter, which was unveiled in the year 2010. And that had many of the commitments given by the department towards saying that, yes, we will give, the department should rectify the orders within 6 months, issue the lower tax deduction certificate within 2 months, etc., and various things, issue the refund, etc. But there was no statutory support or binding provisions in the law. Now, because of this section 119A, though they have replaced the word Citizens Charter as Taxpayers Charter. And we all saw that on 13th of August, our Prime Minister has unveiled 3 of the modules, I would say. One on e-assessment, second on e-appeals, and third was this Taxpayers Charter. The notification as far as e-assessment has already been issued on 13th and on 14th of August. But for the another 2, we are still awaiting the notification as far as the Taxpayers Charter is concerned. However, now we have a section to say that this section was inserted to empower CBDT to adopt and declare Taxpayers Charter and issue such orders, instructions for guidelines which may deem fit for the proper administration of this charter. So I understand that something more positive we can expect, but simultaneously now it's a taxpayers charter, so they are even expecting some obligation from the taxpayer also in turn, which was not there earlier in the citizens charter. Amendment to the due date, that is section 139(1), which talks about the due date, which talks about the 139(1) talks about the filing of the return of income, and subsection 1 specifically talks about the due date for filing of the return of income, which is extended by 1 month from our regular otherwise, which was July and October. July and September, they have extended to by 1 month in the case of September, 31st of October, and we understand because of this pre-filled return, they must have done that to the company. SSU who is required to get his accounts audited, and a partner of a firm whose accounts are required to be audited. Earlier, friends, there was no distinction between a now there is no distinction between a working and a non-working partner. Earlier, they had here the words used were, instead of a partner, they had used the word a working partner. And there were unnecessary disputes. Who is to be considered as a working partner? If a working partner drawing a remuneration is only to be considered, then what about a working partner who is not drawing remuneration? Whether he is not to be considered as a working partner? If he is not to be considered, then the due date would be 31st of July. However, how is he going to show the exempt income by way of a share of profit if he is receiving from the firm where the accounts are not yet finalized because the due date falls in after 31st of July, that is 30th of September. So all those disputes now will be rested, and we have a partner whose due date is going to be now 31st or 30th of November. However, there is no change as far as the transfer pricing provisions are applicable, concerns where the transfer pricing provisions are applicable, that remains as 30th of November. I understand that there further extensions have been allowed for the specific case because of the COVID-19, and that we will relate when it comes to the respective notifications. The fresh extended due date will be considered that time. Section 140 subsection C and CD talks about who is supposed to sign the return of income. The word sign has been replaced by who is supposed to verify the return of income. Now here this amendment talks that in case of a company, earlier it was only a managing director, or if the managing director is not available, then any other director. And if it was a LLP, a designated partner, if he is not available, then any other partner. Now, from assessment in 2021, CBDT is authorized to prescribe any person to verify the return of income. Now, here, to the best of my knowledge, I have not come across till that the CBDT has notified any another person as far as this section 140 goes. 140 capital A, 156 and 191. It is related to ESOP. ESOP for new employer who is eligible for startup under section 80 IAC, wherein we are aware that for the newly startup companies, the liquidity issues were there, and instead of giving incentive to the employees by way of cash, the incentives by way of ESOPs were offered to the employees. But sorry, but since there was a liquidity issues to the startups, and they have extended that, saying that now if this they can make the TDS payment, because these ESOPs are treated as an perquisite. Therefore, the TDS is required to be deducted. However, the TDS can be deducted and deposited, payment can be deposited within 14 days, differing to any of the three cases, whichever is earlier. That is 5 years from the end of the previous year in which the shares were allotted, or the day on which the employee sells the shares, or the day on which the employee leaves the company, whichever is earlier, the TDS will have to be deducted. Amendment to 143, subsection 3A and 3B. This talks about faceless assessment, which again our Prime Minister has unveiled this scheme on 13th of August. This scheme is expanding the scope. Now the amendment, of course, originally it was amendment in 2017 by way of finance. This has come in 2012. Thereafter, now they have expanded by because of this Finance Act 20, they have expanded the scope and they have included even best judgment assessment. And the scheme which was announced was E-Assessment Scheme 2019, which was notified on 12th September 2019. And now further, well, of course, as such, it's not applicable to our concern by the topic direct, but just by way of your updation, I would mention that this e-assessment scheme has been replaced as faceless assessment scheme, and the notification is by way of, I think, 13th August 2019. So various corrections or amendments have been inserted in this old e-assessment scheme, and that include the major, I would say broadly, that includes, earlier it was assessment under section 143.3 carried out for 143. Thereafter, now we saw the amendment 144. And here, because of this amendment that has been recently included by your notification, all the assessments, whether it is reassessment, set aside assessments, all assessments will now be carried out as faceless. Well, that topic by itself is there, so I'm not entering into this area because otherwise I may take up another half an hour or an hour on this section. And I recollect when this e-assessment scheme was there, I did take up as a topic in the JB Nagar study circle itself. Section 144 capital C, that is related to DRP, now that has been extended to non-resident and foreign companies also. 271 AAD. This is another very harsh provision which has been introduced, and many of them are unaware that how and when it is to be applicable. It is applicable from assessment year 2021. So now that says it is for penalty for any false entry found in the books of account. False entry is made, or any omission of any entry which is relevant for computation of income to evade tax is found. The penalty leviable will be equal to the aggregate amount of the false entry. And friends, it does not only talk about in whose books of accounts it is found, even if it is found in the person who is giving a false entry, person who has omitted. So it could be in both the cases. The person, say for example, a person issuing a alleged bogus bill, bogus purchase. The person who has issued the bill, even he will be penalized. The person who has accounted that bogus bill, even he will be penalized. So a person who has accounted the bogus bill, he will be, the addition will be covered in the specified sections of section 69 to 69C. And because of the specified sections, section 115 BBE will be triggered, wherein the tax will be at the rate of 78%, including surcharge and cess. In addition to that 78%, the penalty of 271 AAD, which would be the 100% of that amount of that bogus bill, will also required to be paid. This is what this amendment talks about. So one needs to be very careful over here. Now, okay, I'll read this. Amendment which has been carried out due to the COVID, the ongoing COVID, which has come by way of taxation and ordinance. First is the original due date, which was 31st of July, has been also extended to 30th of November. So the due dates, all the due dates have been extended for filing of the return of income, whether it is a partner, a non-audit, or an audit, or a company, or even a tax or a transfer pricing. All the due date have been extended to 30th of November. As far as the tax audit reports which are required to be uploaded, the due date is 30th of which was 30th of September, has been extended to 31st of October. I do understand that when this ordinance had come at that time, nobody expected, neither the authorities expected that the lockdown period or the unlock period, which is also as good as semi-lockdown, would get extended till date. You are seeing it, and it may get further extended, maybe by way of a month or so. We don't know, at least in Bombay. So everybody is putting his fingers crossed, and I understand that we get a further extension as far as the due date is concerned. But the tinkering, small petty tinkering that they have done is regarding section 234A, which says, though the due date for filing the return has been extended to 30th of November, no relief will be provided for interest chargeable under section 234A in case the self-assessment tax payable is in excess of 1 lakh. However, if he is a resident senior citizen who does not have any income from business or profession, and who is not required to pay any advance tax as per the provisions of 209 and 208 and 9, then the 1 lakh remit of that self-assessment tax paid by the resident senior citizen on or before 31st of July shall be deemed to be the advance tax. So the department expects that resident senior citizen should pay the tax at least by way of self-assessment before 31st of July 2020. And other side, they say that the resident senior should not move out of his office, out of his residence. But still they expect that, yes, you should pay the taxes if it is above 1 lakh, so that 1 lakh will be treated as your advance tax, and thereafter you will not be required to pay any further interest on that. This is only the benefit given to a resident senior if he has already paid the tax till 31st of July. What about to the other persons who are not a resident senior citizen? If his interest, if his tax liability by way of asset tax exceeds 1 lakh rupees, and if he has not paid any taxes till date, then definitely, as per this as per this amendment, he is required to pay interest from 1st of July, from 1st of August onwards, because the due date of 31st, original due date of 31st July has already been over. So he needs to pay interest. What if he has paid the asset tax, say in the month of August, of rupees 5 lakhs, and thereafter now he is not required to pay any asset tax. He has calculated, but the due date of return of income is, say, 31st of November. Let me take that extended due date, 31st of November. Does he have to pay the interest for the month of July, August, or does he not have to pay for the month of July, August? Or does he have to pay interest for the month of, I'm sorry, not July, definitely. Due date was July, so not July, August, September, October, and November. 4 months, even if he has paid asset tax in the month of August, does he have to pay interest for 4 months, or does he have to pay interest only for 1 month, that is for the month of August? That is the issue I have raised over here. As far as this provision goes, they want that, yes, you will still, even if you have paid asset of August, you will still have to pay the interest under section 234A till you have furnished the return of income. But we have one judgment of Supreme Court in the case of Pranav Roy, which says that self-assessment tax paid before the due date of filing of the return of income, wherein now the due date is extended, so he has paid in the month of August, shall also be reduced from the tax liability for computing interest payable under section 234A. Definitely, I understand that our CPC, if you have not calculated, our CPC will definitely raise the liability and calculate the interest and forward you an intimation that, look, you are required to pay the balance interest. But if the amount is substantial and if it is substantial and if it is cost effective, one can prefer an appeal petition under against this intimation, and relying on this Pranav Roy Supreme Court decision, claim that no interest would be required to pay once the asset tax amount is paid till the due date of filing of the return of income. The further this taxation ordinance, which talks about the due date for filing the TCS statements and all that, that is over, I did not consider. Only thing is, the second bullet is important. If at all the TDS certificates have not been issued, which were supposed to be issued with the extended due date of 31st of August, please make sure that you have downloaded your TDS certificates, because earlier we have seen many of them were issuing backdated certificates. But if you have downloaded today, how would you issue a certificate prior to that? Therefore, make sure that you have downloaded and issued the certificate. If not till 30th, 15th of August, do it today, so that per day the penalty is there. I understand the provisions are not harshly looked into by the department. Nevertheless, there is an issue that you should, a provision is there to levy penalty. So, as by way of an precaution, one should be careful. The third bullet talks about an exemption under section 54 to 54GB, wherein if you have not still claim any you are not able to purchase your or purchase or construct for the payment towards the new residential house and take the benefit, or make an investment under 54 EC, thereafter there still you have an opportunity to make the payment till 30th of September 2020. Similarly, as far as the other provisions of Chapter 6A goes, 80C to 80GGC, there the payments, if made up to 31st of July, then you will be eligible for the deduction assessment year 2021. So while making your computation, be careful that do not only rely on the financial statements which are prepared till 31st of March 20. Ask the SSC whether you have made any payment which are required to be claimed as a deduction till 31st of July. And similarly, be careful in the subsequent year, that is March ending 21, assessment year 21-22 also, that if in the financial years, if you have made the insurance payment or PPF payment, and just don't apply blindly the deductions to that year also. If you have already claimed in the earlier year, you will not be able to claim in the subsequent year. So that care needs to be taken even in the subsequent year. I understand that the PF law has not been amended to that extent. What I'm trying to say is that if you have deposited June and claim deduction for the assessment year 2021, the PF law still does not allow you to deposit additional 1,50,000, wherein you can claim deduction for assessment at 21-22. I understand that department PF with the department will amend and they will allow you to make the payment. But otherwise, as on date, there is no such amendment. Today, as on today, you cannot make the claim, deposit that claim, but you may subsequently deposit. Further, friends, before I come to the question answers, we have now a newly, it is connected to the return, filing the return of income. The new 26 AS, when we download now, for preparing our return of income, first we only two things coming out of from 26 AS. One, that is what taxes we have deposited by way of advance taxes, and second was the TDS and TCS. The TDS, yes, we will continue to reconcile with our books of accounts for preparing our computation of income and claiming the credit of TDS. But now, in addition to that, the new 26 AS gives many more further information. So make sure while finalizing your accounts and preparing your computation of income, all those further informations have been taken care of. Say, for example, you have income expenditure, if you have incurred expenditure by way of credit cards up to more than 2 lakh rupees, then also they are capturing. If you have deposited cash or withdrawn cash above a threshold limit, then also they are capturing. So all these additional informations are now given to you by way of 26 AS, and see to it that they are reconciled. I understand that if those informations are incorrect or they are not pertaining to you, they are pertaining to some other SSC who may be your relative, then what do you have to do? As far as filing the return of income, don't have any option. Plans module, which they have introduced a new module, and we will have to address those as and when that comes. Now, can I, Seema madam or any other organizer, should I take up the questions which were
you can take the questions which are already sent to you, and then we will share the screen.
raised to me first, or okay, okay. So I would read first the questions by way of first set which was given to me. There were 3 persons who have raised that question.
Yes.
Okay, you have again, I think, yeah. The first question is whether the electricity expenses, foreign travel expenses, this is about the proviso which has been inserted, etc., to be shown for everybody. The answer to that is no, it is not for everybody. It is not in B section, so it is not applicable to firm and companies. They are not required to say. Now, unless our new ITR asks for this information, because I understand after this question was raised, I just checked from my office and they told me that the ITRs do ask this question, that whether you are covered by the 7th proviso. In ITR 1 to 4, they are asking this question whether you are covered by 7th proviso, and 7th proviso asks this question about electricity expense and foreign travel. If you are filing the return of income because of the 7th proviso and not because of clause A and B, then you need to write yes. And once you write yes, you are supposed to give the amount figures also. So that would complete your return of income, and you require to disclose by way of the module respective field that they have asked for. Clause B talks about, the second question is, in case of business loss from F&O without tax audit, how and which amount to be shown under profit and loss account? I know this is a fight between our disclosure in the ITR and actual proper disclosure, which otherwise we would have done. There is a distinction between a business loss and a business expenditure. Unfortunately, if you see the entire module of the in the entire ITR, the module profit and loss account, they have an expenditure. They have expenditure which shows other expenses. There is no space to show other business loss. Had there would have been a space to show other business loss, we would have included this F&O loss under that respective column. But since it is showing only the available field is to other expenses, you can write down F&O losses as business loss, because you are allowed to, in that field, you can even type the nature of loss or the nature of expenses. So highlight that it is a loss and not an expenditure, and you will be able to go to outcome now to be shown. So what if rent is taxed in only one owner name and not shared? This question is not very clear. However, whatever I could understand from this possibly question would be that investment is made by the first owner, which is 100% investment made by the first owner. The second name is only for the sake of convenience. In that case, your proportion of share would be 100%, and you need not even disclose your second owner's name or the PAN number, and the SSC's name and the PAN number also need not be disclosed. Therefore, the question of the share would not come. Unless there is something else coming out from this question, then I can address it again. But otherwise, what I could understand from this question, I have addressed accordingly. The next one, if turnover above ₹1 crore in case of business and 50 lakhs in case of professional, and they are opting for presumptive tax, then is TDS required to be made for assessment year 2021? Now, first, let me take the easy one. the professional receipts above rupees 50 lakhs, he is not covered by the presumptive tax. He is not covered by clause D. He will be covered by clause B. Therefore, if he is covered by clause B, definitely the TDS provisions all will be applicable. The issue is about if the turnover is more than 1 crore and understanding it is less than 2 crore, though they have not put in the queries has not said that, but I understand if it is less than 1 crore, because if it is above 2 crore, then he will be covered by clause A. So to get covered by clause E, I am saying that it is less than 2 crore. Then first of all, you will have to see what was the turnover in the assessment year 1920. For the TDS applicability, a person whose turnover was there for 1920 who was not covered under tax audit, his preceding previous year's turnover is required to be seen. So in the preceding previous year, if his turnover was within 1 and 2 crore, and if he has opted for 44AD proviso, that is, if he has not if he has already disclosed the profit, then except for section 194C, 194C different as far as the TDS applicability is concerned, and the provisions for section 194A, H, J, L, all there, the wordings are referring to turnover of subsection A. And clause A talks about turnover of 1 crore rupees. So if the turnover is more than 1 crore, then the TDS provision will be applicable as far as A, J, H are concerned. As far as C is concerned, it will be only if it is above rupees 2 crore. But let me clarify here that now in amendment by way of Finance Act 2020, they have amended, and there the link of 44 AD has been delinked. First they were linking to 44 AD, now they have omitted the word 1 crore. So now that for applicability of TDS, you don't have to link with 44 AD. Now straight away the section you will have to refer to. The next one is capital gains liability in the hands of exact some fair there, and whether the legal hair can whether one can take the benefit of that COVID. Presuming if it's not a COVID case, then very technically, if you see the wording used under 54 ECR, investment is to be SSC, and the SSC both are different. The amount of the SSC are used for the investment, but the investment will stand in the name of the disease. No, it cannot stand in the name of the disease. It will be in the different SSC from the regular, but however, we have certain decisions wherein the courts have taken a liberal view, more in context that this is a beneficial provision, and if it is the same amount which was invested, and within the time available, that is the 6 months, if it was invested, then the courts have allowed. But I would be still, in my view, it would be a case of a dispute unless it is a dispute which the SSC would like to buy it and fight for it. Then it's a case one can try again in the court of law. The next one is, I'm on F question, that is F&O loss of 4 lakhs and turnover of F&O 22 lakhs. Total income after loss 20 lakhs, whether tax audit is required to be done. Again, I have already explained in detail the presumptive taxation, that is as per to as per clause E and section 44. Very technically, the answer would be no. Because this is the first year. I understand this is the first. But for all practical purpose, even for filing your return of income, the answer would be yes. They will be asking you, if you upload this detail, they will immediately trigger what is the date of submitting your tax audit report. And if you leave it blank and if you proceed, maybe you will be inviting that it is a defective return, and thereafter you need to rectify this defect. The next question, G, is on individual gifts listed shares to HUF. If yes, then the cost will be the same as that of the individual, or will it be 1/4/2001 rate can be taken as cost for the HUF as shares are old. Whichever is later, that can be treated individual if it was acquired by the individual prior to 1/4/2001, then that prior date will be treated. Otherwise, 1/4/2001 date will be treated as the date for the. If it's a list, as it is mentioned, it's a listed shares, then the beneficial benefit of that grandfathering will be allowed, and then thereafter the tax at the rate of 10% will be long-term capital gain at the rate of 10% will be required to be paid by the HUF. Can one HUF give to another HUF? Now this is very broad. Is it like the HUF or there's no connection or no relation? HUF B be treated as an income for 56 to 10. Assuming the option as defined under 56 to 10, the relationship as defined under 56 to 10, then one can take the benefit of the Rajkot tribunal decision followed by a decision. You should see the relative qua this members of the HUF. I-1 talks about if turnover for financial year 2021 is 1.5 crore and profit less than 6%, do we have to do the tax audit? I think we have covered in our talk, so I will not repeat it again. Coming to the next batch of questions, second batch, which was by Sanjay Domadia. Under presumptive scheme, and by way of an example, that the question relates to that under presumptive scheme, I am supposed to declare the profit of say 6%. However, section 44AD says that you can declare 6% as the, or the SSC, as the case may be a sum higher than the aforesaid sum claim. So a sum higher, I am reading the provisions of section 44AD subsection 1. So it is 6% or 8% or 2 in clause subsection 1. So by way of an example, if I have to explain, turnover is 1 crore. The SSC has offered 6%, which comes to 6 lakhs rupees. And he has paid the taxes and he has capitalized also in his books of account 6%, absolutely no issue. But if the turnover is say 1 crore, 6% net profit, and he has capitalized, instead of 6 lakhs, say he has capitalized 12 lakhs. And he has made investment of that 12 lakhs also to show that, look, 2 lakh rupees I have incurred by way of foreign travel, 10 lakh rupees I have made an investment in equity shares. Now, how will you justify when the expenditure is concerned, as far as the investment and then expenditure is concerned? Because I understand you are not required to maintain the books of accounts, only to the extent that you are just to justify that, look, my turnover was 1 crore. To that extent only you can say that my books of accounts are there. I understand you need not maintain books of accounts. Also 44AA does not allow or does not require you to. But when you, how will you able to justify your expenditures or the amount that you have capitalized in your books of accounts of 12 lakh rupees? There you will be again, and the provision also says nobody would like to, so much to declare that, look, I have earned 12 lakh rupees, so I'm paying tax at the rate of 12 lakhs, though the section is telling me to pay 6 lakhs. Therefore, my suggestion would be that you will not be able to capitalize a higher amount. I can understand instead of 6 lakhs, it is 6.5 lakh. Then I can explain that no, the 2 lakh rupees, the 50,000 difference is out of my past savings, and where I have not maintained the books of accounts. But a huge difference, it would be a difficult case to argue. Coming to B of Sanjay Bhai's question set, how to treat the difference of 19 or 17% of book profit, since we pay income on deemed profit of 6 or 18. I'm unable to understand what is this figure of 15, 19 and or 17. So my inability to understand this question, I skip this question. Assessment year 2021 under presumptive scheme under section 44 AD or 44 ADA, whether balance sheet and profit and loss account are required to be reported in ITR. The answer is clear no. If you are covered in the presumptive scheme, you are not required to maintain the books of accounts. The answer is a clear no. However, since this question was there, I had to refer to my office, and they told me that even if you are not maintaining books of accounts, the 4 fields are there in the balance sheet, which requires that you are supposed to report as far as your debtors are concerned, creditors are concerned, and cash balances. You are trying to report these 4 figures in the balance sheet. Similarly, there are 4 figures even in your profit and loss account, but these 4 figures are not mandatory figures. As far as the 2 figures are concerned, they are not mandatory. The gross receipts is mandatory, gross profit not mandatory, expenses not mandatory, net profit mandatory. Similarly, when you come to ITR 4, there are 13 fields wherein you need to put the figures. If you are not maintaining your books, but all out of these 13, the debtors, creditors, stock in trade, and cash balance, the balance figures are not mandatory. However, if you have readily available, you can give those figures. If it is not readily available, you may not give those figures. I just got a feedback that my voice is cracking. I hope, well, I have not moved from my place. There could be some internet issues as far as this voice cracking is concerned. But I will try to come little closer to the mic now, since I have since this remark has come. Coming to the next set from Narendra Mehta. Narendra Bhai's first question says the person during financial year 1920 having income from commission and insurance, and he also has trading in shares. His commission from insurance company is 60 lakhs. He has trading in shares and purchase, which is 50, he is trading, he is not an investor, which is 50 lakhs, and sale of shares is 90 lakhs. Since this and sales are taking place from old stock, audit under AB, I have section 44 about the commission, which talks about the turnover for business, and clause which will cover my purchase and sale of shares. Therefore, the turnover of my shares is 90 lakhs. Then I am out of that. A. Coming to the commission business from insurance commission from insurance company, which is 60 lakhs. Clause E has a proviso, not a proviso, clause E, I'm sorry, section 44AD, subsection 6 to 44AD, which says that following category of persons are not covered under 44AD subsection 6. Subsection 6 says so. So 44AD subsection 1 will not be applicable to them. And the insurance business, that is the commission from insurance, will not be covered as far as 44AD goes. Therefore, this 60 lakhs will become part of the turnover which needs to be considered for clause A. So clause A, I said that it is not applicable because it was 90. Now that clause A becomes 90 plus 60, 150, so it becomes applicable, and therefore he is required to get his accounts audited. B, it's only books of accounts kept for both business. I think this B is connected to A, so I understood, I have replied. C, dividend is considered as business income on shares trading held for trading. Well, it does not make any difference, because I don't know why this question, even if this dividend is not considered business, it has to be considered as a business income because he's a trader, and that will be part of his gross receipts for the purpose of section 44AD. If sales of shares are 70 lakhs, then will it make a difference? I didn't understand what difference it would make whether it was 70 lakhs or 90 lakhs, because even if my turnover is 70 plus 60 that I have explained in the example, it becomes 130, which is above the threshold limit of 1 crore. So it should not make any difference as far as it is 70 or 90 is concerned. This is the set which I had readily available with me. Now, if the organizers are okay, I will take up the questions which are from 4 onwards from Rahul Jaju.
Please, sir. I know we are running out of time, but we can take the questions.
Okay, sure. So there is no relief of marginal rebate of income above 5 lakhs as it was. I appreciate, that is why I said, and that is why I very specifically gave an example. So 10 lakh, 5 lakh 10,000, you will be spending 5,000 rupees more. You will be paying a tax of 15,000. But this is the harshness which we will have to face it. That's why I said that if possible, you should use the, if it was possible, you can plan that 10,000 could have been reduced. The next question is from, again, Sanjay Bhai Domadia. Special depreciation rate of 30%, or yeah, that is, say on 1st October for 2021. What will be the rate of depreciation for assessment year 21, 22? Is it 30% or 40? Yeah, it will continue. You will be in the higher block of depreciation. So 30%, you will continue with the same 30%. And you will not come back to the 15%. The next one is, again, if wife or mother not filing return and husband or son incur expenses on their behalf. Yeah, so then even if they are not filing the return, the person who incurs the expenditure for himself or for any other person. So you will have to consider both together. The person who is filing the return already does not need to give details of foreign travel. Yes, I have already mentioned that if he is filing the return under clause A, that is a firm or a company, clause B, if his income is already taxable, then he will say that I am not filing the return of income because of the proviso to section 139(9). Then he does not have to give any of these details. Next is from Bhagwan Pal. USD purchased for travel and used in US will be part of expenditure for travel to a foreign company. Yes, definitely. Yes. I understand you are a resident and you are filing the return of income, or even if you are a non-resident, you are required to file the return of income, then yes, it will be considered as your foreign, as a travel expenditure, even if it is in the USD. That's a different thing, that person who is in US, he will not be reporting it to the Indian agencies, any of the Indian agencies. That is a different aspect altogether. But otherwise, very technically, you are required to uh, report over here. What if electricity meter is the name of a deceased person? It does not talk about the whose name it is. It talks about the expenditure for consumption of electricity. So even if you have income and expenditure, the electricity meter or the bill is not in your name, but check for consumption. If you have incurred this expenditure exceeds the threshold limit, you need to make a, you are covered by the seventh proviso. 194M, whether it applies to the amount exceeding 50 lakhs for all nature. I have already answered this. Then from Shishantu Damania, if a company has purchased commercial vehicle before so and so date, but could not put, I think the section is very clear. They are telling you that put to use before 1/4/20. So this I appreciate that this is a matter of concern, and the department should consider this, but they should come by way of a notification that this particular section should be amended and extension should be allowed to this also. But as of now, I am also not aware of any such notification. But definitely the notification issued for tax saving scheme and capital gain will not apply. A specific notification for section 32 needs to be expected from them. Mr. Gurpreet Singh says that what if payment for work, brokerage, commission or profession is paid to different persons? Then definitely not. If it is this threshold limit of per person is applicable. Again, Mr. Bhagwan Pal wants on 115 BAP, new company engaged in manufacturing also in service. The said company satisfy all conditions. It's not for service, it's for only manufacturing unit. So will no, if it's a mixture, it's going to be a very big difficulty. Only if the service is connected to that manufacturing. Say you have a different bill for sale of your product, and along with that product, you even give the service for way of annual maintenance or repairs. If it is connected to that, in that case only the services will be covered. If it is not connected to manufacture, I have my own doubt whether it can be covered. Manoj Prajapati, an organization who has applied 44 AD and required to get tax audit as declaring profit less than 8% of gross percent, is 10 need to be applied, means such company required. As I told you now, 44 AD, 44 AB, so therefore indirectly even 44 AD has been dealing with the TDS provisions. Independently, if your turnover now exceeds 1 crore, you need to deduct TDS and therefore you need to apply for the 10 number provision. What if F&O loss 4 lakhs? And I think I have covered. This is a repetition of the same query. Rupal Haria, I think no. So, I think Rupal Haria. I'm on question number 16. I could not read the Rupal Haria's question. Niti wants to know what if firm. Sorry. Again, okay. I'm on 15 again. Rupal Haria, having turnover between 2 crore to 5 crore, not required to get. I think I was not clear in the proviso that has been introduced for the purpose of 44 AD. A proviso which is concerned regarding clause A, that is, if your turnover is more than 1 crore but less than 5 crore, subject to the two conditions of receipts and payments being less than 5% in cash, both the conditions getting satisfied, then you need not get your accounts audited if it is less than 5 crore. What if firm having turnover of 1.5 crore and having loss of 10 firm? Okay, 10. Whether audit is to be done? Very good question. A debatable question. No direct answer to this. But my personal view that when they say maximum marginal rate tax, whether zero, that is nil, is to be treated as also a maximum marginal. To me, it appears yes. So firm whose income is below zero, that is below one, then that is the maximum marginal and need not get the accounts audited. This is my view. But I understand that a different view is also available, and which says that maximal marginal has been used in different contexts at different places, wherein it talks only more connected to the individuals and HUF. But I do not concur with that view. Okay. Now, if business is entitled to 44 AD, the turnover is less than 1 crore, profit less than 6%, and turnover is more than whether tax or turnover is less than 1 crore. Are there two questions or is it one question? If one place you are saying turnover is less than 1 crore, but less than 8% or 10%, it doesn't make a difference. If by proviso also you are covered and your turnover is less than 5 crores, there is the question of 44 AD. And total income is more than 2.5 lakh. Yes, definitely you need not get your accounts audited because you are covered. I understand both the conditions of receipts and payments are getting satisfied. Radhakishan Menon, I suppose that is the absurdity. I'm again on Srinivas Mullaya's case. That is the absurdity which I wanted to bring it out. That if you are having a turnover of up to 5 crore, you want to exempt that. But I replied that you have to get your accounts audited.
Yeah, right.
Sorry, my mistake. That is the absurdity which is created.
Yeah,
I'm so sorry. Yeah, I stand rectified for question number 70. Radhakishan Menon, I suppose filing of tax audit report is 31st October. While filing income tax return is, yeah, I think I made it very clear. And in otherwise also, if the slides are circulated, you can refer to my slide also. The extended period by way of the ordinance, what I have given, it is definitely 31st of October. Tax audit related to 44 AB, I understand, and not tax audit for transfer pricing and all. Transfer pricing, it is 30th of November. Is the date of investment in capital gain bond also extended? Yes, it is also extended, because I understand the question why I think that ambiguity is there, because while press release, they had said section 54 and 54G. When it came by way of a notification, it was 54 to 54G. Therefore, it is covered. The actual interpretation is it is 2 and not N. So it is extended. The next from Satish Bhave, which is blank, or unless Sima madam, you scroll it down.
Yeah.
The time? For long-term capital gain from residential house, whether the investment or deposit in capital deposit account till 30 November, due date of no, not till 30th of November. It is extended till 30th of September. So forget if you were supposed to invest within the period from I think 21st of March or 20th of March till 30th of till 29th of September, and if you have invested till 30th of September, then you will be eligible for this deduction. So the question of till 30th of November or the due date does not come into picture. Shitanshu Damania for assessment in 1920. Processing is done under 143.1, but SSE has found now that he had not included certain income. Time for filing revised return has already expired and the processing is also completed. Still, a revised return can be filed. Are you asking me, can a revised return can be filed? The answer to that is no. Whether department would process this return if the revised return gets uploaded? Well, if it, by any chance, if it gets uploaded, well and good, nothing wrong. You should always take a chance so that you don't have to pay the penalty. Whether SSC can make very rectification application, well, the rectification application can be only if there is any mistake apparent from the record. If the intimation is out of your return of income, which you have filed, and there is no mistake, then 154 cannot be applied. However, your earlier option that if I'm allowed to upload the revised return, then that would be definitely a better option. If I'm allowed to upload, then you can always go and try this option. I'm on question number 22, again from Shitanshu. If cost of shares of the previous owner is not available when shares are devolved by will, what date and cost of acquisition is to be taken? Oh, now here it says cost to the previous owner. By any chance you can get some material to see that it was acquired by the previous owner prior to 2001, then you can replace it by 2001. Otherwise, it will be the onus will be yours to prove what will be the cost of acquisition. Had a question, otherwise, if by any chance still you say that it is not at all available, then the only option, the later date, that is the date when you have received by way of your will, that will have to be taken, or the department will take that. Had the question regarding presumptive taxation tax audit for manufacturing who have a turnover of more than 1 crore and less than 2 crore and do not satisfy the less than 5% cash receipt. Do you have to undergo tax audit and forego filing their returns under presumptive taxation? I will again say that if it is less than 5%, you don't have an option. You are not covered by subsection 4 of 44 AD. Therefore, the proviso to clause E will not apply. And because of the proviso that has been inserted, you of the higher threshold limit from 1 crore to 5 crore, the condition of cash payment, cash receipts and payment need to be satisfied. If you do not satisfy, then definitely you need to undergo tax audit. Yeah, on question number 24, if you want me to take up, otherwise I am okay. That depends upon the availability of the time.
No further question.
Okay, okay.
Yeah, the questions are over.
Okay. Thank you. I once again thank the organizers for giving me an opportunity and to deal with the questions. And I special thank that I was required to understand what the ITRs also do want us to do, and what are the options available with the practitioners or the SSCs. Thank you once again to everybody.
Thank you, Mahendra bhai, for the wonderful session. Information was very nice in your presentation, and you answered all the queries raised by the participants. It is really great thing, and I also thank you, Mahavirji, for listing all the questions.